Good morning, ladies and gentlemen. Let us just have a look at these two charts, one next to the other. This is a chart of the 5-year note yield, and this is a chart of the DX, the dollar index. They are absolutely identical charts. We just wanted to show you this to pictorially represent what we say to you every week, and that is that the 5-year note is the leading indicator of interest rates, and that interest rates actually determine the price of nearly every other asset immediately. So if we guess the direction of the 5-year note, we will be guessing the direction of the dollar index over the course of the next few days. So without further ado, let us see what the 5-year note did last week and how it churned us up and down. Last week we said that we can't see it going any higher than 118.08, and guess where the top was? Yes, 118.08 to the tick. The really important area now is the 117, 12.7, call it 13, and 117.08 and a half, call it 08. This is the area where all the distribution took place in the past week, and we really need a close below this area at some stage to indicate that the uptrend in yields is going to continue. I can't stress enough how important this area of consolidation is. We tried very hard to place our trade at a good level. We just found that the market was too short, covered, stopped us. We weren't able to reinstate our trade where we wanted to, which was between 06 and 08. It just backed away from that level far too quickly. Now it is crunch time over the next few days, because if we can't take out this area, the 15, or call it 13 to 08, if we can't take out this area, we will go and test the 118.08 area for sure. This is naturally going to have huge repercussions for all asset prices. I can't see at the moment what would take it back up towards the 118.08 area, but it is going to cause huge movements in the dollar and in equities if this was the case. Having good levels to watch is as important as having a position. So now that we know that 118.08, which we've identified a while ago, is extremely important, and now that we've identified the 13 to 08 area, well, 90% of our battle is done. We know where we want to trade. We want to trade on a close below here, or we want to trade on a close above this level. And we also know what asset classes we need to jump on board if these closes materialize. On a longer term weekly basis, we can see exactly what the market has done. It has gone and backed off from the 23% retracement of the entire move up in yields, and it closed above this 1.875% yield level that contained the 5-year note for nearly 3 years, which is telling us that the uptrend in yields is technically intact. We are absolutely sure that the 5-year note at some stage is going to trade this 0.35% level, where the uptrend will probably exhaust for a good while. At the moment, we still have an incomplete wave structure to get us to the in the yields, and we are quite sure that we will get up there. The question is how many times we will stop out people who have put on the short 5-year notes like us before we actually reach that level. Are we absolutely sure that we go there directly from now? No, we're not. We think probably there are quite a few more weeks of indecision before the break is made, and that fundamentally makes sense because we are all awaiting some Trump policies to be enacted as opposed to just speculating that there will be some. So we're not surprised to see continued pressure on 5-year note yields to get people as square as possible before a quick spurt in 2 or 3 weeks time that'll get us to the target of 2.35% yield. And what we have said for the 5-year note is now completely reflected in the dollar index. We now anticipate quite a few days of trying to break above 103, being unsuccessful, coming down, testing this 100.5 level, probably exceeding it slightly, letting the moving averages catch up, and then all of a sudden making a huge move higher, probably towards 105, 106. So we know where we want to buy it. We want to buy it around the 150 area, and then we want to position ourselves for a nice ride up towards 105, 106. Having looked at the 5-year, we need to look at TLT, which is 20s to 30s, because that is showing a slightly different picture. It is showing a picture of a flattening yield curve, with this being a medium-term bottom which could contain the bond for quite a few weeks until we see the 127 area. We have now started to turn the moving averages. The technical indicators are correcting from very oversold negative levels going towards neutral. We could easily see several weeks of movement, slow movement up towards 127. It then will be we will be ready to make the next move down, which we anticipate will take the 30-year note down towards 100, which will be a dramatic movement indeed. What does that tell us? That tells us that actually Trump will implement some policies that will get the fixed income market scared. That is what we anticipate. We naturally are willing to be proved wrong, but this is what this picture is telling us. If the 127 area doesn't hold it and the market is disappointed, we could easily see a move all the way back out to 136, 137. We don't anticipate that that is going to be the case, but you can see that we are still at some very unsustainable levels. Either we top out at 127 or we go a full 10 points higher. So those are major moves in the offing over the course of the next few months. Given that we have such an unstable picture in two very important assets, and that is fixed income and the US dollar, it is to be anticipated that we will have some repercussions in the equity markets. This is a chart of the volatility of the VXB, and it's showing volatility. Basically, this is a weekly chart, at the lowest levels that we have seen in, well, human history. We did have very briefly volatility below 10 in 2007, before we all know what happened, and it looks like we are heading there again. We're showing you this because some counter trend indicators that we follow are showing an amazing confluence of volatility and prices in indices coming together and showing counter trend rotation about to take place. It does make sense to us fundamentally that if the fixed income and the dollar are going to have huge moves, it also makes sense that there will be adjustments in price in equities. So we are just showing you this to give you an idea of how dangerous it is to be too long of equities or the wrong index at these levels, because basically you are beginning to pick up pennies in front of a steamroller. Very important chart, very long term. Doesn't tell you anything today, but it tells you to be careful about position sizing in equities at the moment. Drilling down into ES, as far as we're concerned, absolutely nothing has changed. The market very slightly took out the high and then settled below again. The indicators are extremely overbought. The market is extremely overbought. It's right on top of the daily Bollinger Bands. We see very little sustainable upside in the ES, and we see unsustainable prices in the VXX. We have the beginnings of some very odd negative divergences. We really feel that at this level, yes, can we see 2300? Yes, maybe. Can we see 2310, 20? Yes, but we are playing for 1 to 2% of upside for the distinct possibility of a quick 5% down in the daily charts of ES. As we will show in a moment, if you're playing ES, you're actually playing a combination of XLV and XLK. XLK is tight up against the top of the Bollinger Bands, indicating that the upside is in the next few days is not that great. It is just going up with the moving averages at a very, very slow gradient, and it is unlikely to provide much further upside to push to ES. A much better and more violent move can take place is in NQ. NQ is no respecter, no huge respecter of the Bollinger Bands. It can go 2-3% through them and then come back, but that also shows you that it always does come back and test the breakout point of the Bollinger Bands. So what we are saying is that even now, if it starts going up and a further 3-4%, we can guarantee that within 10-15 days it'll retest this 5,000 level that it's broken through. Again, if you want to be long, aggressively long, NQ is a much better proposition than ES. How we are at an extremely important juncture in all equity markets is emphasized by the Stoxx 50, which is a market that we actually prefer to the US. 33.25. We've mentioned this level. It has not closed above it. It is now even on top of these trend lines, and every time we've been to 33.25 we have had a violent reaction away from it. When we closed through it at the beginning of 2015, we had a further 10-15% move higher, and when we couldn't go and close through it, like in 14 and in 16, we had at least a 10% move down. So we are on the cusp of a major move, 10 to 15%, either up or down. This is very, very important, and again emphasizes our point that all prices are at very, very unsustainable levels. We will not be here for long. We will either in the next couple of months come back down and retest the 3000 area, or we will bust through this and go to at least 3600 within the next couple of months. So the first quarter will close either at 3600 or at 3000, or at least will test those levels. Unfortunately, the investing.com has changed their charts, so we can't actually see them magnified as we used to. I hope you can see this well. This is a chart of the 5-year note, the bubble in Germany. As you can see, it's been stuck between the sort of -30 to -60 area, and it has been here throughout 2016. We would like to finally see a move out of this range, and what would bring us to a move out of this range? Well, we actually, if you think about it logically, why would anybody keep money at negative interest rates? Well, because there has to be one fundamental reason, and that is you can't see what else you can buy which is less risky, and therefore you are willing to give up 20 basis points a year for the safety of holding German paper. At some stage that has to end. If people start seeing equities exploding higher, they have to, however much the ECB is buying, people would just say, I don't want to hold this at negative interest rates, and they would just sell all their holdings. So we actually think that if we see a move into positive territory in the 5-year note, that will be the sign that you want to buy European equities. That will be our major trigger, and that would actually break that 33.25 area that we have been telling you about in stocks. If people no longer want to hold negative interest rates, then it makes sense that people will start investing in equities. And we think that this is going to be the big move of the year, out of negative interest rates and into equities in Europe, because people can now see some growth and some return of inflation. Fundamentally speaking, in ES, absolutely nothing changed last week. We are hard up against this 17 times Blue Angel. We doubt that anything much is going to change over the course of the next couple of weeks. The market is basically waiting for Trump to prove it right or wrong. However, we feel that at this level it is a disproportionate bet that the market is making. It could go up 2 or 3%, or it could come down hard all the way back down towards the 16 times Blue Angel, which is hardly above 21.25. So the market is actually giving you probably a 3-to-1 risk reward to sell it, but those are probably the odds that Trump does nothing. We think he will do something. We just can't see that he will do something so extraordinary as to justify these valuations here, and move these Blue Angels substantially higher. But that is just our bias. We can't be sure of it. So the market is doing actually what makes perfect sense. It is doing this and is waiting for the for some proof of the pudding before it moves substantially one way or the other. We just feel that this break is actually going to come down, but we are willing to wait and be proven wrong. In the meantime, the only sectors which make fundamental sense to hold are XLV, because it is fairly priced, and XLK, because it is also fairly priced. We feel that the support of XLK, which around 4 to 5% lower, is going to be huge, and therefore we are quite happy to hold or initiate longs in XLK related indices like the Nasdaq over the ES. We think that that is still going to be a profitable trade, long NQ, short ES, over the course of the next few weeks until more clarity comes from Trump. So finally, the biases for next week. As we wrote last week, and we've left this up, we can't see the market going higher than 118.08. That is going to be an extremely important area on the upside, as is 117.0813 on the downside. We will watch this level very closely and sell the market and buy the dollar if there is a closing break of this area. Bunds, we haven't seen the 03 to 06 yield area, but any move up there towards the 165, 166 area, we want to be major sellers. ES still, we think that ES has very little sustainable upside. NQ is preferred for longs, as all week it's happened. ES has done almost nothing. NQ is substantially higher. The Russell 2000 is completely stalled, but it's still our preferred long-term long instrument. So if Trump does do something, it's going to be reflected in Russell more than it is going to be reflected in ES. So we are quite actually happy that the Russell is doing not a lot and is probably retracing slightly, because if Trump does do something, it'll be a much better buy. Of course, we want that to be proven by action rather than just words and expectations, which is the current situation. European equities, we can't stress how important this 33.25 area is. We want to see a weekly close above it to initiate longs. We think longs around 33.25 are very, very poor risk reward, because the market could back off substantially before it retries it and breaks it. So the US dollar, again, because of our view of longer term view of the 5-year note and of TLT that we expressed earlier, we still think you have to be long of volatility. The market could easily trade 108 to 110 area in the next few days in the US dollar, euro US dollar, and then back all the way back to parity or 101 again on some Trump action. We think the next 2 or 3 weeks are actually going to be very volatile, and therefore we just can't give up this trade. Thank you very much indeed, and see you throughout next week on the website. Thank you.